Hello everyone. Welcome to Citi Personal Wealth Management's webcast, The Year Ahead, How to Navigate Both Volatile Markets and the New Tax Laws. Our guest speakers today are Shawn Snyder, Head of Investment Strategy for Citi Personal Wealth Management, and Chuck Cavanaugh, Head of Wealth Planning. Before we get started, we would like to provide you with important information you need to keep in mind during today's discussion. Investment products are not FDIC insured or bank guaranteed and may lose value. Past performance is no guarantee of future results. Diversification and asset allocation do not guarantee a profit or protect against loss. Citi and its representatives do not provide tax or legal advice. The information discussed in today's presentation is intended to be educational and should not be construed as investment advice. To discuss your individual situation, please schedule an appointment with your financial advisor. And now, I'd like to turn it over to Shawn and Chuck.
Hi, I'm Shawn Snyder, Head of Investment Strategy for Citi Personal Wealth Management. Joining me today is Chuck Cavanaugh, Head of Wealth Planning for Citi Personal Wealth Management. We're going to talk about Citi's outlook for financial markets in the year ahead, as well as the new tax law changes that may impact your 2018 taxes. However, before we begin, we'd both like to wish you a Happy New Year and thank you for registering for our webcast.
Happy New Year, everyone. Speaking of the new year, I'm guessing that most investors are more than happy to say farewell to last year. Shawn, can you give us a quick recap of what happened last year and then share how you think 2019 might unfold?
Absolutely. Unfortunately, most asset classes actually experienced losses in 2018. In the US, the S&P 500 finished the year about 6% lower. Global equities finished the year about 11% lower. Not devastating losses, but certainly worse than we were expecting, and we were actually on the more bearish side of things at the start of the year. As far as what happened, I would say the largest factor was probably the changing expectations about the global economy. Investors started the year talking about strong, synchronized global economic growth, but by the end of the year, we were talking about a noticeable slowdown in both Europe and China and a rising possibility of a US recession. In some ways, we see that trend is continuing in 2019. The US economy now expected to slow as well. Overall, our economists still expect the global economy to grow by about 3% in 2019, but the US may slow to a pace of about 2% by the end of the year as the stimulus from the tax cuts start to fade. Unfortunately, this expected slowdown has made things difficult for investors because no one knows exactly how deep of a slowdown it will be. Right now, we're in the camp that thinks it's a modest slowdown and not the start of a recession.
And what are some of the reasons that you think this is a slowdown and not a recession?
There's obviously a ton of economic data points that one can point to, but let's just take a quick look at the yield curve, which is one of the best predictors of a recession. If you're not familiar, the yield curve is a difference between short-dated bonds and long-dated bonds. As an example, a 10-year Treasury yield is normally higher than a 2-year Treasury yield because you're taking on more risks by holding a longer-term bond. However, sometimes the yield curve inverts, meaning that the 2-year yield is higher than the 10-year yield. This doesn't happen a lot, but when it does, the recession tends to occur about 16 months later, and stocks tend to peak about 10 months later. This is very simple analysis, but if you use this, that means that stocks tend to peak about 6 months before a recession. Right now, the yield curve is actually still in positive territory with a spread of about 17 basis points, or in plain English, that means the 10-year Treasury yield is about 0.17% higher than the 2-year Treasury yield. Given that the stock market tends to peak after inversion and not before, we still think that the market can move higher from here. If we look at the last 4 yield curve inversions, the S&P 500 returned an average of 19.7% before peaking. So we're actually calling for a 14% return this year.
So let's assume that the economy remains healthy in 2019. What are some of the other risks that are out there?
There's always a lot of risks out there. I think most should acknowledge that. But I would say that probably the 2 biggest risks are the normalization of central bank policy and trade policy. A lot of people may not be aware of this, but the most recent sell-off picked up steam on October 3rd when Fed Chair Powell said that he thought that they were still a long way from the neutral rate. The neutral rate is basically the rate at which the Fed would stop hiking interest rates. So with the global economy already slowing, this led investors to fear that the Fed would make a policy mistake and hike rates too aggressively and cause a US recession. You've probably heard the old market adage that bull markets don't die of old age, but the Fed murders them. This perfectly describes what investors were worried about in December. Fortunately, a lot of those fears have eased after Fed officials came out. They said that they would not hesitate to make a change in policy if conditions changed. They also said that they could afford to be patient with inflation still muted. I do think there's still some chance that the Fed surprises markets this year. The economy does hold up well in the first half of this year. I could envision a scenario where the Fed is tempted to raise interest rates at least 1 or 2 more times. As far as trade policy, it does look like the U.S. is moving towards a deal with China, but things could always sour. The U.S. and China currently have agreed to hold off on additional tariffs for now, but that truce is set to expire on March 1st if they do not get a deal. If that were to happen, I think stocks would react negatively to that news. Speaking of negative things, let's talk about taxes. Clearly a lot has happened in financial markets last year, but it also seems like a lot has happened as far as the new tax laws. With everyone starting to receive their income tax statements soon, could you give us an overview of what we should be looking out for this upcoming tax season?
Sure. Most Americans' tax bills changed last year, but the question is, how much did they change and what impact will that have on their investing and overall financial planning going forward? Everyone's situation is different and time will tell. Let's first take a look at some of the tax law changes. In general, the individual income tax rates were reduced for most Americans. We still have 7 tax brackets, but with a top tax rate of 37% compared to 39.6% in 2017. In some brackets, the tax rates actually went up. The Tax Act also slows inflation adjustments in the tax code. What makes long-term planning tricky is that most of these individual income tax provisions expire at the close of 2025, and then in general will go back to the 2017 tax rates.
So clearly some very broad changes. What do you think are the key changes that our clients need to consider?
Well, first of all, the Tax Act repealed the $4,050 personal exemption you used to be able to claim on yourself, your spouse, and each of your dependents. As a result, some families with many children may pay higher taxes. Not great news for some taxpayers. But the standard deduction has nearly doubled for joint filers from $12,700 in 2017 to $24,400 in 2019, and for single filers from $6,350 in 2017 to $12,200 for 2019. So it's likely many more taxpayers will be using the standard deduction in the coming years. So better news for many taxpayers. The Act may also significantly reduce the number of taxpayers who will itemize deductions. One reason is the reduced cap on mortgage interest deductions. Starting in 2018, mortgage interest on total principal of as much as $750,000 in qualified residence loans can be deducted, down from the previous principal limit of $1 million. But the Act has eliminated home equity loan deductions entirely. However, there will still be interest deductions on using home equity loans for improving the home, as opposed to using the funds for non-home related items such as buying a car or paying off credit card debt.
We've heard a lot about how the tax law changes will adversely impact individuals in states with either high income tax rates or high property taxes. Can you talk a little bit about that as well?
Of significant importance to many of Citi's clients in high tax areas like New York, New Jersey, California, Connecticut, and the District of Columbia is the change to the state and local taxes itemized deduction, also called the SALT deduction. The new rules have capped the total SALT deduction at $10,000. This limit will apply to the combined amount of state and local income taxes and property taxes paid during the year. This increases the amount of taxable income for those taxpayers impacted, exposing the taxpayer to more taxes and possibly pushing some into higher income tax brackets. It also likely increases the number of people who will claim the standard deduction. It's important to know that some states are trying to create workarounds to allow residents to recharacterize state and local tax payments as deductible charitable contributions, but the IRS is pushing back, so stay tuned for further developments.
Is there anything else that we might be overlooking?
Well, the Tax Act also expanded the benefits of 529 college savings plans. If you're saving for your child's college education, the new rules allow you to use up to $10,000 per year of your college savings to pay for elementary school and secondary school costs. The Tax Act also exempts almost everyone from the federal estate tax. The new tax laws doubled the estate and a gift tax exemption in 2018. In 2019, the exemption is $11.4 million per person, or $22.8 million for couples. But remember, the state estate tax exemptions are often much lower than the federal level and may or may not be linked to the federal exemption amount.
It's a lot of great information, but how does it impact financial planning?
Well, let's take a look at 6 key planning areas, including tax refund planning, retirement planning, estate planning, charitable giving, business owner planning, and investment property planning. With tax refund planning, you may want to consider directing any tax refund you may receive due to the tax changes to meet a particular financial need. For example, you could consider making an allowable contribution to your retirement account or use the windfall to pay for an unmet insurance need. With retirement planning, although retirement plans were left largely unaffected by the tax law changes, be careful about making a Roth conversion. The new law removes the ability to recharacterize the Roth conversions, that is, to change back to a traditional IRA or retirement plan that you originally converted from if the Roth no longer makes sense. With estate planning, remember the new law increased the federal estate tax exemption, now at $11.4 million per person for this year, but the tax code could change in the future. Estate planning is a long-term proposition, so don't make rash decisions based on the current law. Also, estate planning was never just about taxes. It's important to re-examine your existing estate plan, including your wills, powers of attorney, revocable trusts, and insurance plans.
Chuck, with estate planning, if someone wants to make charitable donations, has anything changed there?
Yes, with charitable giving, the charitable deduction for cash gifts to public charities increased from 50% to 60%, so it may make sense to consider charitable giving strategies for larger gifts. Given the doubling of the standard deduction, some clients may want to consider pooling their cash gifts or appreciated assets in certain years to beat the expanded standard deduction amount. This is what accountants call bunching. With business owner planning and the various changes in business income taxation, a key question for business owner planning will now involve entity selection. Should businesses be structured as C corporations with the new reduced income tax of 21%, or as a pass-through entity with a 20% deduction on flow-through qualified business income? In some cases, S corporations will want to reconsider their S election. Of course, you should talk to your legal and tax professionals about what makes sense for you and your business. Lastly, with investment property planning, if someone owns investment property such as collecting income from a multifamily home, keep in mind that under the new tax laws, you can still defer taxes when selling the property by exchanging it for similar like-kind property within a period of time. But there are personal assets such as artwork and collectibles where you can no longer defer taxes by making this like-kind exchange. Another important point: investment property owners who use an LLC or other pass-through vehicles to own their real estate holdings should find out if they qualify to deduct up to 20% of a real estate business's net income. So overall, during the tax season, it's a good time to reach out to your tax professional and Citi Personal Wealth Management financial advisor to discuss the impact of the tax law changes on your investments and planning strategies. Also, talk to your financial advisor about a complimentary personalized financial plan. The plan will enable your financial advisor to help you design your investment portfolios in a way that's aligned with your different financial planning goals and needs.
It's a great point, Chuck. I would also stress that right now is probably a good time to review portfolios to make sure that your portfolio is not only aligned with your long-term goals, but also properly aligned with where we are in the business cycle. With that, I think we'll conclude today's webcast. Chuck, thank you for sharing your knowledge with us today. Once again, I'm Shawn Snyder.
And I'm Chuck Cavanaugh.
Thank you for watching.
We would like to remind everyone that any products or asset classes mentioned here are as general market and financial planning commentary and may not be suitable for all clients. You should speak to a financial advisor about your specific investment objectives and risk tolerance as part of your decision-making process.